Hey, this is Mike Swanson of Wall Street Window. I want to talk with you today about this. This is 1 ounce of gold, and I own lots of gold. And you can own physical gold like this. You can also own gold in a brokerage account through exchange traded funds like GLD, IAU, and so forth. Now, gold as a strange thing is happening with gold this year in terms of the US dollar index. I want to talk about this in the video. And also the real purpose gold now serves an investment portfolio, because the relationship historically with gold and the US dollar index is kind of broken down this year, or last year too, for that matter. You see, historically, gold uh, is very closely correlated to the price action in the US dollar index in a negative way, meaning that when the US dollar index would go up, gold would go down. And when the dollar index went down, gold would go up. So people in the United States have thought of gold as a way to hedge against declines in the US dollar. And you've heard over the years, uh, people bullish on gold or want to sell gold saying buy it because one day the US dollar is going to collapse. Well, that day is not going to happen overnight. It's not going to collapse suddenly overnight. That's another topic for another video. But more importantly, let me show you what's going on. The dollar's been going up, and it hasn't really been impacting the price of gold at all. So here's a chart of the US dollar index going back 20 years, and you can see that it made a new 20-year high this year. The international turmoil helped gold go up. But ironically, the situation of global inflation, it's not just inflation in the United States, but around the world, has ironically helped the US dollar index, because the United States, the Federal Reserve, has been more hawkish, more aggressive in raising interest rates, even though I think there's still got a lot more to do, than has been the case in Europe and in China. In fact, in China, they lowered rates just this week. So that's helped the US dollar index go up. And gold is not just something bought in the United States, but all over the world. So what has happened is, when you look at this chart, let me show you, there's two interesting things. One, the CRB index, that's the Commodity Research Bureau index, had a tremendous rally after it made a low in 2020. It's pulled back recently, but gold trades with that. Gold is in that index, and so is silver and other precious metals. It's a part of it. It's a broad-based commodity index, includes energy, agriculture, and so forth. And the rise in that index helped contribute to the inflationary pressures that began last year and only picked up momentum as this year, as the calendar flipped to this year. And so gold and silver had a nice rally, and now they're pulling back. But the bottom of this chart is a correlation indicator, which compares the price action behavior of the US dollar index on this chart with gold. And I'm using the 200-day moving average of prices. So this isn't a short-term indicator, but it's very meaningful. The more longer-term indicators used, the more meaningful they generally are. And what it basically does is say, okay, when the dollar index, if it goes up, say 1% and gold goes up 1%, that actually is perfectly correlated. If dollar index goes up 1% and gold down 1%, then it's a negative correlation. And when this reading is close to 1, it means it's a perfect relationship to the upside, and -1 is completely negative. When dollar index goes down, gold goes down the exact same percentage. Well, as you can see, historically, and going way back before 2003 for that matter, typically this correlation index is low, very close to -1. As I said, that's because historically gold trades opposite the US dollar as a hedge. But this year, that has not been the case. In fact, the correlation swung up to positive 0.75 when around the time of the war in Ukraine started, and now it's come down where it's around zero. And in a way, that correlation index, it went up in 2021 too. So what this is, to make a long story short, really over the past year, there hasn't been a consistent trading relationship as there historically has been between the US dollar index and gold at all. And when you're near zero, which it's close, it's at 0.24, zero would mean the relationship there really isn't any. It's almost like random. So what's the takeaway from this? At the moment, and it's been this way for over a year, really, there's been no real trading relationship between gold and the US dollar index. And it's going to take some time for the long-term historical pattern between the two to reassert itself. And it could take a year, it could take 5 years. So thinking about the US dollar index, look, in gold isn't useful right now. If you want to buy gold or sell gold, don't think about what the US dollar index is doing. You got to think about other stuff. And here's where I'm going to tell you, suggest why gold is important. If the US dollar isn't falling and making gold go up, why should you care? Why did so many of the gurus got it wrong on gold? Well, okay, here's a price chart of gold. Gold is in a consolidation phase. It's been in one since 2 years now. We had a great rally up to 2,100, and then that peaked. We came back down to 1,700, which is long-term support. It was the low of 2021 twice. It's where the lower 200-day Bollinger Band is. In gold, in the short run, I don't really think it's going to go back up to 2,000 without consolidating more around where it is now, and it could actually retest 1,700. That's okay. A drop from just back down to 1,700 from where it is now, it really is pretty meaningless. Doesn't mean anything. So short term, what gold might do next week, I'm not really bullish about it. I'm not that excited about the short-term trading in gold. Look, right now in the stock market, everyone that's playing is gambling up in the meme stocks. They're not chasing commodities right now. They're not chasing gold. The individual trader got beat up very badly and punched over and over and over again this year as the stock market corrected and fell and declined. It would vicious leg down, and now there's a relief rally, and they're getting back into the game, as it's showed in past in Sunday video, getting into the meme stocks. Some professionals are getting a lot more cautious. Michael Burry, according to recent filings, has liquidated just about his entire portfolio. He's got one position worth $3 million, and this is a guy that's a billionaire. So a lot of people are getting negative in the market. Elon Musk did a filing selling over $1 billion of his Tesla stock, but they got a long-term outlook. The day trader is thinking about meme stocks playing, for hours or a day or two and so forth. What about gold? They're not interested. Gold isn't on their radar screen. But gold is on my radar screen. It should be on your radar screen if you have an investing philosophy in this market. And why is it so important then? Well, the bottom chart is dividing gold with the S&P 500 to create a gold to the S&P 500 relative strength plot. When this goes up, it means gold is outperforming the S&P 500. When it goes down, gold is lagging. And gold outperformed the stock market from the end of 2000 till around 2008, 2009. There was a secular bear market when the NASDAQ topped out, and gold was better to own during during the 10 years it came than the Dow, than the NASDAQ. And then around 2012, gold began to lag the stock market, and it went into a bear market that ended in 2016. And now starting in, really in towards the end of last year, gold started to outperform the stock market along with the CRB index. And now that's taking a little bit of breather as this relief rally in the stock market, he started about 6 weeks ago, 2 weeks, almost 8 weeks ago, is playing out. But, in a year in which the stock market fell below the 200-day moving averages, and those moving averages are resistance, gold outperformed the stock market. Gold is up for the year, while the S&P 500 and the NASDAQ are actually still down for the year. So gold, if you made a trade on January the 1st, if your choice was owning gold or the S&P 500 or the NASDAQ, you would have been better off to put your money in gold and still be better off if you put your money in gold because it's up while all this other stuff is down. Now, most investors in the United States try to diversify by putting, 50% to 60% of their money in the stock market and then the rest in the bond market as a safety trade. And most investment advisors will then say, okay, we're going to rebalance that allocation. So if the stock market falls and your bonds go up, we'll sell some bonds and buy stocks. And that sort of rebalancing is a great money management strategy. 4 years ago, I did an entire course on that, which I need to update and release again because it's really the core to principle to long-term investment success. But what I want to point out to you is that simple strategy of, let's say, 60% stocks, 40% stocks, in bonds. It's rebalanced. It has beat the stock market since 1980 because what it does is, ironically, by reducing risks, it boosts returns. And that's why it's such a popular strategy with investment advisors. Because historically, when the stock market would go down, bonds went up. But that entire relationship has broken down because bonds tend to trade opposite to what they do to the yields that they generate. And when interest rates went to zero in 2020, what we saw was a peak in the bond market that will never be surpassed, a secular peak. And bonds are now in a secular bear market. Yes, you can get rallies of 6 to 12 months, but after that, interest rates going to zero in 2020, from then on, we're in a secular bear trend in bonds, and inflation is a big reason why. And we can take a breather in interest rates going up or bonds going down, but it's just a breather in a long-term secular trend. The problem is this is making bond funds go down this year, and that has caused that 60-40 or 50-50 stocks to bonds investment strategy completely fall apart. That has hurt stock market, the average investor trying to diversify, be safe, just as much, actually at this point worse than the drop in the stock market. Because take a look at this, the TLT ETF, which tracks treasury bonds, is actually down 20% for the year. At the moment, it's down more than the stock market. So it is completely failed as a safety trade. When the stock market fell, it was going down. And now that the stock market's rallying, it's not going up, hardly at all. So it's almost the worst thing one can own in this market. Sure, there's lots of bad stocks that I think are junk, but if my choice was stocks or bonds, I would be in stocks because that 60-40 stocks bonds portfolio, it's over. That investment strategy ended 2 years ago. It no longer works, but few people have adapted to that reality at all. They're still holding on to it because most people They don't think too deeply. They just think, oh, they tell me this is what I should do, so I'm going to do it. And I've been doing it for years. If I make a change, I could be wrong, and I don't want to be wrong. I'd rather lose money. Don't think like that. When it comes to bonds, bonds are the worst things to own in this market. Sure, look, I do own CDs. Short term, I'll sometimes go to cash and put money in CDs for a month or two, but I'm not owning them for a long time. I'm not owning bonds and holding them for years. They're just a place to park my money every once in a while, and then I get out and do something else. But as investments, no. As short term, whatever, okay. But I'm speaking about the 60-40 allocation. It's over. So what this creates is a dilemma, because if you want to diversify, you can't be invested in one thing. So if you don't want to buy bonds like me, and I don't, that's my view. I don't want to, as a diversification tool, doing rebalancing every year. I don't want bonds. So what do? That's where gold fits in as an investment portfolio now. So take a look at this chart. This is actually the TLT ETF, and you can see the relative strength for that actually made a new low today. So the underperformance of bonds to stocks started, ironically, in 2020, just when the market crash ended, and is just continued on and on and on and on. And the outperformance of gold is doing great. And so is the stock market. But I don't want to own all my money in stocks. Gold is a way to diversify from stocks. And you can look at the correlation indicator. I talked about the relative strength on the bottom here. Correlations in the middle of gold to the S&P 500. And as you can see, it's close to zero. So gold is something that doesn't trade lockstep with what the stock market is doing. And therefore, if you want to diversify from stock market risk, you want alternative bonds, that's gold, that's commodities. And that's why gold is now a critical investment, not just a short-term trade, but something to help manage the risk in investment account, to play the role that bonds used to play and no longer are working as they had in the past. So I think this is an important thing to understand. It's not about quick money. There will be times when gold has a big rally, and the mining stocks typically go up much more than gold. So if you want to trade gold for shorter term gains, I would say mining stocks. I would say small cap mining stocks. If you want to be kind of like an option trader and speculate. At the moment, they're in a correction or a sideways pattern. But anyway, wanted to talk about gold with you. And I'll tell you, physical gold and physical silver, they're fun to own, because when you buy them, you kind of put them away. You don't think about them anymore. You don't see the daily gyrations that are pretty meaningless. And there's no better way, if you think you want to get out of the cash system, than to buy physical metals. Bitcoin, crypto is not an alternative to the financial system at all. People who've seen the crypto exchanges fail know, in fact, they're worse than an alternative. They're a debacle at times. Much more risky to own crypto than the US dollar, than gold. Crypto goes up and down so much in any given day. It's so volatile. It only magnifies the investment risk that you take on if you think that crypto is something to put 5 or 10% of your money in. You're just increasing your risk. You're not decreasing them. And crypto is never going to replace the US dollar. Never. It's never going to happen, because it's not money. It's not a real store of value. And therefore, it's not money. It just isn't. And that's the world as it is. Sure, I know Bitcoin people make predictions to you, but those are predictions. I deal with the world as it is. I don't care what the gurus say. So if you like this video, if you want more videos from me about what's going on in the gold market, precious metals market, hit like. And if you're new to what I'm doing on YouTube, Click the subscribe button, click the bell next to it. YouTube will send you an alert when my next video is up.